A borrower requires bridge financing in a particular situation, and that situation is when they sell their current home after they purchase their new home. So for example, let's just say you sell your house closing 90 days from now, but you purchase your new home 60 days from now. The bridge loan would bridge that gap of 30 days in between, because the money that you'd have available for the down payment would be tied up until you sell. The bridge loan amount is really calculated as your purchase price minus the deposit that you give to the seller when you make your offer, minus the mortgage amount that you would require given a certain down payment. So that's the bridge loan amount. Another way of expressing that is that your deposit plus your bridge loan would equal to the total amount that you'd have as a down payment. A bridge loan is a little bit more expensive than a traditional mortgage per se, and usually the rate is similar to an open mortgage rate or a personal line of credit. So right now in the marketplace, bridge financing goes for about prime plus 2. That gives you an effective rate of 5%. And the interest rate is really inconsequential. It's only to bridge a certain number of days, so you shouldn't be too concerned about the interest rate. Now, given that the loan is so short term, the lender also doesn't make very much money off of that. And there's a lot of administration that needs to happen. So most lenders will charge an administration fee of anywhere between $250 to $500 depending on the lender, depending on the length of time, and the actual bridge loan amount. In order to secure a bridge loan, the lender would expect that you produce a firm sales agreement and a firm purchase agreement. So you'd have to have both of those agreements totally executed in order to arrange bridge financing. Most institutional lenders will not offer or provide a bridge loan if there isn't a firm sale date. So if you've purchased a home and haven't sold your home yet, it's unlikely that an institutional lender will provide the bridge loan that you would require. So it is an absolute requirement that you have both a purchase and a sale agreement for both properties. Most bridge loans have a limit as to how long they can be. 90 days is the max. Now, if your situation is such that it's open-ended, that you haven't sold your property, then you may want to look into private mortgage financing for that bridge loan. But I can tell you that the private financing would cost a pretty penny. You'd have brokerage fees, all kinds of legal fees involved. So you definitely want to make sure that you have a firm sale date when entering into a bridge loan. So are bridge loans registered on title as an actual mortgage? And that's a great question. It really depends on the lender, depends on the length of time, and it depends on the actual bridge loan amount, whether the lender will actually instruct your lawyer to secure the bridge loan on title of the property. Of course, if the lawyer is involved at that level, there would be additional legal costs that you would incur. However, most lenders offer a bridge loan as a promissory note where it isn't registered, and the promissory note, of course, gets discharged once the sale of your property occurs.